What is going on, guys? There are 5 quality stocks that are on my list right now. These stocks are undervalued for one reason or another, mostly due to some sort of overreaction, whether an earnings overreaction or a news story overreaction or a mix of the both. And as you know, I'm not a proponent of completely divesting from the market based on the indicators that we see, because trying to time a correction or a pullback is an exercise in futility. It does not mean that there are times when you shouldn't be more careful than others. However, trying to time it and staying completely out of the market is a no-go in my opinion. You do not want to miss the best days in the market. Now, I will give you this list of top 5 stocks that could be extremely lucrative. These are top 5 quality stocks towards the end of the video. But first, I will go over a brief market update based on the current landscape and an update of the current plays that we have in our private trading group, and then I will get into those 5 stocks. But before I get into it, welcome back to The Traveling Trader, your source for non-BS, regular, concise market updates. If you get anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know if you hold any of these 5 stocks, and if not, why. And let's get right into the videos. Now, as of the time of this recording, we just received the private payroll numbers. The private payroll numbers show you the number of jobs added in the private sector in the United States. Private payrolls rose by just 330,000 jobs. Now, analysts were expecting jobs to rise by 695,000. This is dismal compared to the analysts' expectations, less than half. However, there is a record 9.2 million job openings. So there is some sort of disconnect there where the 9.5 million people who are unemployed are not filling these jobs, either because they don't want to, they're incentivized by the government because they're getting some sort of COVID relief at the moment, or there just aren't enough skilled workers to fill these positions, or a mix of both. Either way, this points to an economic slowdown. Now, so far, the market is digesting this information negatively. Now, before these numbers came out, the stock futures were actually green or trading flat. However, they have turned heavily red since those numbers just came out. Now, don't forget, the non-farm payrolls actually come out on Friday, and that is what the economists use more as an economic indicator because those are related to manufacturing jobs. And manufacturing is seen as the backbone of the economy. So while the private payrolls are still a slight indication of an economic slowdown, the non-farm payrolls, if those are at par, then the market might ease up a little bit on its view regarding the private payrolls. The bond yields continue to drop as investors flock to bonds. This means that the Fed is less likely to raise rates this year. I didn't think they would anyway. I did say that I think they will start having to raise rates by next year. However, this might speed up their timeline of tapering. They might start tapering by the end of this year. Tapering is just a fancy word for stopping the purchases of assets and bonds. So what does that mean for the markets? As I said, I do think that a pullback to a correction is likely due within the next 2 or 3 months, but I do not think that we will see a full-on crash, not even until next year. Crashes and bear markets are actually very rare in the US stock market, but pullbacks and corrections are more common, obviously. The market is looking like it is forming another temporary top. We could see another drop to the 50-day moving average for the SPY at around 428. Now is the perfect time to talk about some of the plays that we have, because one of the plays that we have is related to this. We have a hedge against the SPY. Now, a hedge is not a main play. It is just a play that represents a very small portion of your portfolio that allows you to gain some cash back in case there is some stagnation or a pullback in the market. Generally, you want to keep it to about 1 to 5% of your portfolio. Now, if you don't hold any S&P based stocks, it actually doesn't make sense to have a hedge, because what the hell are you hedging against? Now, I promise I'm going to get into these top 5 stocks to buy, but we do have call spreads against Apple, the 150-155 call spread that's up 22%. We have a put spread against Snap that's up around 24%. I have a neutral diagonal spread for GM for earnings. Let's see what they report on earnings this morning. And we are currently down on a Moderna put spread, although in pre-market it looks like Moderna is dropping, which is good for our put spread. We just need it to be under 365. The reason that I opened up a put spread for earnings on Moderna is because I believe that most of the action is already priced in. The earnings will be seen as a COVID tailwind, and there is a good chance that we do see a sell-off after earnings are reported, unless something completely unexpected is actually announced. And if you want access to all of our trades, link is in the description below. All right, so what are the top 5 stocks that I'm looking to buy right now? These, as I said, are mostly earnings overreactions or overreactions based on news stories. And if you're a fan of this channel, you know that we love buying quality stocks and overreactions. The first one is ATVI, or Activision Blizzard. This one tanked, although beating out earnings. Now, there are a few reasons why Activision tanked. There is a labor dispute ongoing, as well as some Me Too type allegations. Obviously, Netflix announced that it was entering the gaming industry. There was the Chinese threat on online gaming companies. However, in my view, these are distracting headlines and do not warrant a 25% reduction in the company's value in the matter of a few months. Do you really believe that Activision is 25% less valuable than it was a few months ago just because of these headlines? It pays a healthy annual dividend and its gross profit margin continues to grow year over year. It is also a highly profitable company and its net income margin also continues to grow year over year. Its revenue growth year over year is almost 33% compared to a sector median of 1.6%, which is dismal. Dismal for the sector median, great for ATVI. It is also somewhat protected in a pseudo lockdown environment in case we do see more restrictions imposed due to the Delta variant. Another stock that stands to benefit from a pseudo lockdown environment is Amazon. Now, Amazon has the benefit of benefiting from a lockdown environment or a fully reopened economy. It has its hands in so many business sectors that it doesn't matter. An 11% drop at the 100-day moving average on a blue chip, if you're not willing to buy that, if you're a retirement investor or a long-term investor, then I don't know what you're doing. They completely crushed earnings, missed slightly on revenue, although they reported a third quarter in a row of $100 billion or more in sales. No need to spend too much time here on Amazon. Another stock that I called out in a previous video sitting at the 300-day moving average is Pinterest. Pinterest is now up more than 5% since bouncing off of the 300-day moving average. Not only is this a great stock from a technical perspective, sitting at this major support level going all the way back to November 2020. However, just a few days ago, Pinterest also beat out its EPS estimates. Now, the reason that it tanked so much, it's down almost 35% from all-time highs. It's because its user growth was slowing down. However, if you look at Pinterest's revenue per user, it's actually growing astronomically. It is also oversold on the RSI. The last time this happened was in May 2021, shortly after earnings went from $55 all the way to $83, back down to below $60, which in my view is a perfect opportunity to enter here for the long term. Stock number 4 also has earnings coming up today, and that is Etsy. However, I don't mind buying this before earnings. Obviously, buying before a binary event could pose a risk. However, Etsy is sitting at the 200-day moving average, and I don't mind buying here and buying again if we do see it a drop. Now, if you are a risk-averse investor completely, you will want to wait until earnings are reported before jumping in. Now, Etsy was trading at almost $250 just a few months ago, currently sitting at around $190. If you look at its growth numbers, this is nothing short of impressive. Revenue growth year over year, 133% compared to a sector median of almost 9%. Revenue growth forward, 50% compared to 7%. EBITDA growth year over year, 391% compared to a sector median of 39%. And so on and so forth. It maintains an A+ profitability grade on Seeking Alpha. Gross profit margin is 74%, EBIT margin 26%, EBITDA margin 28%, and so on and so forth, compared to a laughable sector median in almost every single category. And stock number 5 is Disney, sitting at the 200-day moving average. Disney just announced that it was going to be selling its annual passes once again. It is killing it in streaming. Their parks are starting back up again now. On Disney, if you, again, were a risk-averse investor, you can wait until it reports earnings next week, especially because it's creating this head and shoulders pattern here on the 1 day, which is usually bearish. If Disney does fall to the 157, 158 range, then that is when you would dollar cost average a lot heavier. Remember, these are long-term plays. Please do not try and swing trade from a YouTube video, mine or otherwise. Anyway, traders, that is it for this video. If you got anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know which one of these stocks you are trading. If you want access to all of our trades, link is in the description below. Sign up. We'd love to have you. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.